Welcome back, traders and investors. We're talking a little bit of Forex coming here. This is Kyle Bazzi filling in for Joe Elconin out for the week. I have next guest Greg Michalowski, president of GregMikeFX.com and author of Attacking Currency Trends. Now, Greg, you're a veteran, 28-year veteran of the financial markets. Tell us a little bit about your background.
Kyle, I've been involved in the market now for about 29 years now. The first 15 or so were from the institutional side of the market, worked at Citibank, Credit Suisse First Boston, had an opportunity to work overseas at Citibank London for 4 years, then transitioned over to the retail sector, spent 13 years with FX Direct Dealer. At that time, I was able to see what a lot of retail Forex traders do right and what they do wrong, and kind of filled me out, if you will, understanding what the institutional side does, what the retail side does. Just recently started a new venture, gone on my own, Greg Mike FX, and starting to build that up, and as a Forex consulting firm mainly for the retail sector.
All right, I'm going to drop your Twitter link there in the chat room for everyone listening to go look at what Greg is talking about. And Greg, what are you talking about right now? Is your approach, obviously with Forex more macro or more technical?
My approach is more technical. I look at technicals as the primary tool for traders. I do have a fundamental bias, or try to have a fundamental bias, or an understanding what's going on the fundamental side. But the fundamentals don't tell me where I'm wrong, Kyle. The technicals tell me where I'm wrong, and I'm more concerned about risk. And I think most traders should be more concerned about a risk side of the equation, how much you stand to be taken out of your account if you're wrong, and that's what the technicals do for me. So it's always, my focus is on both, but if I were to I have a primary tool, that's the technicals. I have a secondary tool, that's the fundamentals.
Let's talk about that real quick. I'm reading a really good book, Abnormal Returns, and the first chapter appropriately is labeled risk. And we always talk about risk reward, and we need to talk about risk first, because as retail traders and a lot of our newer type traders in the chat room, that's often overlooked. How do you approach risk, and with the technicals, how do you set it?
I use very simple tools that a lot of traders out there see. If you look at a chart, the instinct is to connect lows to lows and highs to highs. Those are trend lines, and then you have moving averages. The moving averages that I find are used and followed by a lot of traders, 100, 200 bar moving average. And then I use Fibonacci retracements because the markets trend and then they correct. And so those are the tools that I use, and I use them to define my risk, limit my risk. And then the final step is to accept your risk. So you lean against these, what I call borderline levels. They're support and resistance levels, of course, but I like to think of a borderline, where it's New Jersey on one side, New York on the other side, and either you're on one side or the other, buy or sell. And if you lean against those levels, you find times where there's you get really great trade location, and that limits your risk. I am not saying don't take risk. We, of course, have to take risk. But if you don't think about limiting your risk, then I feel that a lot of retail traders have unlimited risk. They don't know where to get out. What level does the bias turn from bearish to bullish or bullish to bearish? And so that is my focus, and what I try to steer traders toward is trading near these levels where you can, what I like to say, lose a little and have the potential to make more than a little. Now, the more than a little can be, that's your reward. That happens because you didn't lose a little. You traded, the market agreed with you at those key technical levels. And so if you're able to believe in those tools, they're very visual. A lot of people can see them, so they sort of have that. There's going to be some sort of reaction against those levels. So if you believe in those, and then you start to trade those levels, you'll find that your risk is little and your rewards can be more than little. Remember, if you risk a little, the chance to make a multiple of what you risk is much greater. It's much easier.
All right, in your book, Attacking Currency Trends, How to Anticipate and Trade Big Moves in the Forex Market,
Hmm.
how we got a little bit of your foundation of how you're trading and looking at the
Right.
technicals, but how do you anticipate in trade big moves in the Forex market?
Well, one of the ways, Kyle, is look for air times when there's not big moves, when the market's consolidating, and things like the euro versus U.S. dollar. I think we had about over the last 15 or 16 days, we've been in about 112 pip trading range. Two moving averages are converging. The 100 and 200 bar moving average are converging near a level like 133.75. I'll give you that level. The 50% retracement of the move up from the July 2013 low to the May 2014 high is 133.75, right where the 100 and 200 hour moving average are at. So that's my energy level this week, okay? And we've been consolidating around that level over the last 8 or 9 trading days. In fact, 8 of the last 9 trading days have traded above and below the 133.75 level. What does that tell me? That tells me that the market is coiling like a spring, or it's getting tighter and tighter right around a key technical level. It ain't going to hang around here, Kyle. I look for a move this week. And the thing is, I don't know which way it's going to go. I don't know which way it's going to go. And that sounds kind of weird to people that, oh, he doesn't have an idea of which way it's going to go. When the market non-trends, what's it saying? It's saying that it doesn't know which way it wants to go. The buyers and sellers are equally balanced until they become imbalanced. And so I'm going to be focusing in on that big bar that breaks out on the top or breaks out on the bottom, that moves away from the 133.75 level this week. And and if I see that bar, I'm going to go with it, and I'll look for that rotation either to the upside or downside, and look for a bigger attack. I'm going to attack the currency trend at that time.
All right, and kind of piggybacking off that, this week is a big week with Jackson Hole coming up
Hmm.
and the Fed's minutes. What are you looking for, and how are you setting up around that news?
Um, well, we know that Jackson Hole, they're going to be talking about employment. We know that, we pretty much, what do we have here? Let's just focus on the euro as an example. So it's a euro versus US dollar. We know that Yellen they're happy that the unemployment rate's coming down, but she's concerned about the slack and the other employment statistics, the participation rate, some, higher unemployment for younger people. So, there's all little things that she keeps on focusing on. So I don't see how she can change her mind automatically. And on the other side, we have Draghi speaking. We know inflation's down. If he's supposed to speak about unemployment, which a lot of times he kind of just glazes over. Unemployment is still high. He doesn't. It's high. It's high over there, and youth unemployment is particularly a concern. So if he has to focus on his speech on unemployment, it shouldn't be, I don't know where you can find some good things to say about it. So, if I were to have a fundamental bias, I think it's still that the euro is more under pressure as a result of, low inflation, high unemployment. Um, add the Russian geopolitical situation in the equation, and fundamentally it points to the downside. So we'll see how that all pans out. A lot of times you expect something that goes the opposite way, so that's why I'm going to be paying attention to the technicals as well.
All right, we're still looking at the futures right before 5 minutes before the open,
Hmm.
trading higher after a pretty wild weekend and Friday. So you mentioned before we got live here that a lot of the currency pairs are sideways right now. How does that
Hmm.
play into what you're doing?
Well, along those same lines of looking for the breakout, the dollar versus yen, sideways year, basically. The first day of the calendar year was the high price for the year. And then we came down and consolidated. If you look at a dollar yen chart, it's saying to me don't know which way we're going to go, sitting around the 100 and 200 day moving average. Not that, we're not talking about hourly charts. We're talking about 100 and 200 day moving average. Clearly defined trend line at the top, clearly defined trend line at the bottom, triangle formation. Let's see which way we're going to go. So, that's going to be, that I'm looking for a move. I don't think the year's done with the dollar versus yen. I think there's going to be some sort of, catalyst to move it to the upside. Most people think it's going to go higher because Japan's going to slow more. They're going to need more stimulus. Now we'll see. We'll see what happens. And again, I'm just sitting tight, ready to go. Hands on the trigger of the gun and looking to fire. The pound sterling. We got a little rebound back today, and we've been trending, of course, down to the downside off of the 172-ish type area in the pound over the last month's worth of trading. But what was key on Friday, Kyle, is we came right down to the 200-day moving average. If there's a currency that's not been going sideways, it's the pound, but it has been correcting of the move to the upside here. We came right down to the 200-day moving average, Kyle, almost to the to the pip, and we bounced off of that level last Thursday. Friday we held, and today we have a little gap to the upside. So it's showing a little bit more bullishness in the pound versus U.S. dollar. Those are all comments from Carney, who kind of took back a little bit of his dovish comments last week in the inflation report. So a little bit more more bullish here on the pound. It's been the especially off that 200-day moving average, and the the Aussie and New Zealand kind of consolidating as well recently, hanging around key levels like the 100-day moving average for the Aussie and the 200-day moving average for the New Zealand. A little bit more positive here on the New Zealand. We did move above the 200-day moving average and back above a trend line there around the 84.62 level. So if the price can remain above that level, then that's a little bit more bullish for the New Zealand versus U.S. dollar.
All right, Greg, really appreciate it. We got some great insights there, and it's definitely going to be an interesting week with the Jackson Hole coming up, and also the end of what seems to be QE3, and what will the market do. Greg, thanks for coming on with us today. Hope to have you back again sometime soon.
All right, hope to be back. Thank you very much, Kyle.